Since the implementation of steep tariffs on Chinese imports, major U.S. ports have experienced a sharp decline in container traffic, while consumer prices at supermarkets have surged. Are American households quietly bearing the cost of an ongoing trade conflict with no clear resolution? In April 2025, the Trump administration imposed a 145% tariff on all Chinese imports, an unprecedented rate that has severely impacted trade between the world's two largest economies. One immediate consequence: a sharp drop in container traffic at the ports of Long Beach and Los Angeles, the largest cargo hubs in the U.S., which have seen volume fall by 44%. The Port of Seattle, once a key gateway in the Pacific Northwest, has seen traffic nearly vanish. Together, these three ports handle 40% of total U.S. imports and about 30% of exports. Over half of their shipping volume is tied to trade with China. The sudden slowdown has disrupted supply chains, impacting logistics, transportation, and jobs in port-reliant areas. For American households, these empty ports are more than just a symbol of broken trade. They signal rising prices, fewer product choices, and potential shortages of essential goods. With tariffs disrupting supply chains, imported goods have grown scarcer, driving up costs. Major retailers like Walmart and Target have raised prices by 10 to 30%, depending on the category. From groceries and clothing to electronics, few sectors are spared. Economists estimate American households are now spending an extra $2,300 per year just to meet basic needs for retirees, those on social assistance, and middle-income families. This added cost is a serious strain. Meanwhile, the Consumer Sentiment Index, a key gauge of economic confidence, has dropped sharply. Inflation expectations have reached their highest point since 1981, reflecting widespread concern over price stability. For many older Americans who lived through the inflation of the 1970s and 80s, these signals stir difficult memories. In contrast to warnings from economists and business leaders, former President Trump has called the drop in Chinese imports a good thing, viewing it as a way to boost domestic manufacturing and cut reliance on global supply chains. However, major retailers like Walmart, Target, and Best Buy have pushed back, arguing that a 145% tariff is not something businesses can simply absorb. With already thin margins, raising prices is the only feasible option, ultimately passing costs to consumers. This gap between trade policy and retail reality reveals a deeper disconnect, and within that divide, it is everyday Americans, especially seniors and those on fixed incomes, who are likely to feel the most immediate and lasting impact. Experts at the University of Pennsylvania have called the current tariff wave the largest reverse tax reform since 1993, adding an average of $1,190 to household expenses in 2025 alone. These costs are already showing up in higher utility bills, food prices, and medical expenses. Forecasts also suggest U.S. GDP could fall by up to 6% in the long term, with worker incomes dropping by 5%. This threatens both growth and the consumer spending that drives the economy. Particularly concerning the risk of supply chain disruption in critical sectors like technology and healthcare. Hospitals are already struggling to source essential equipment from Asia, including electronics, medical gloves, and diagnostic tools. In this climate, it's more important than ever for households, especially families and older Americans, to monitor spending, plan carefully, and take steps to protect financial stability. Intense negotiations between the U.S. and China in Geneva have concluded with a framework agreement aimed at temporarily easing the trade war, yet, with gold prices hitting record highs, and American businesses continuing to warn of policy risks, the question remains, is this truly a victory for the U.S. economy? On May 12, 2025, after 2 days of negotiations in Geneva, the U.S. and China reached a temporary agreement to reduce tariffs for a 90-day period. Under the deal, the U.S. lowered tariffs on Chinese goods from 145% to 30%. China reduced its tariffs on U.S. goods from 125% to 10%. The tariff reductions are expected to ease price pressures on imported goods, especially in sectors like toys, apparel, and electronics. However, the 30% U.S. tariff remains significantly higher than previous levels and may continue to affect consumer prices and product choices. The agreement includes a phased tariff reduction mechanism contingent on China fulfilling commitments to open its markets and end currency manipulation. However, prominent U.S. business leaders, including Warren Buffett and Jamie Dimon, have voiced concerns. High tariff levels are hurting domestic companies, and there's a lack of transparency in trade policy. The uncertainty surrounding trade policies could lead to price volatility and weakened consumer confidence. As a result, American consumers may continue to face unstable prices and limited product choices, at least in the near term. President Trump signed an executive order aimed at maximizing the extraction of minerals, timber, and seafood in Alaska. The move boosted shares of gold mining companies like U.S. Gold Mining Inc., USGO, with gold prices soaring to a historic high of $3,400 per ounce in early May 2025. Rising gold prices may increase production costs in industries that rely on gold, such as electronics and jewelry, potentially leading to higher prices for consumers. While the temporary U.S.-China trade agreement has eased tensions and provided short-term benefits for American businesses and consumers, the core issues in bilateral trade relations remain unresolved. U.S. consumers should be prepared for further policy shifts and market volatility ahead. In 2025, sudden tariff cuts from 145% to 30% triggered a rapid surge in imports and severe port congestion. U.S. supply chains are strained, and inflation risks are rising. How will these trade policy swings reshape American consumers and businesses? In April 2025, the Trump administration imposed a 145% tariff on Chinese imports, sharply reducing trade flows between the two nations. This move caused immediate disruptions in supply chains and higher costs for U.S. businesses. But in May, the tariff was unexpectedly lowered to 30% for a 90-day period, prompting American companies to rush import orders. Shipping bookings from China to the U.S. spiked over 50% in the first week of May, as firms scrambled to secure inventory before potential tariff reinstatement. Despite the tariff reduction, American consumers continue facing rising prices due to increased shipping and warehousing costs. Economists warn this volatility could drive inflation higher and push the U.S. economy toward recession if trade uncertainties persist. The inflation outlook remains fragile, with transportation cost increases directly impacting consumer goods prices. These tariff swings mean higher prices on everyday products, tightening household budgets, especially for middle and lower-income families. Increased import costs affect retail prices nationwide, while inflation pressures reduce purchasing power. Businesses face uncertainty in pricing and supply availability, complicating planning and investment decisions. U.S. ports like Los Angeles, Long Beach, and Seattle experienced extreme fluctuations due to the tariff changes. April saw a 44% drop in cargo volume at Long Beach, reflecting stalled imports amid high tariffs. But in May, cargo surged sharply as importers rushed goods before tariffs could rise again, leading to severe congestion. The ports oscillated between near inactivity and overwhelming demand within weeks, disrupting logistics and increasing delays. Port congestion delays goods reaching shelves, causing shortages and erratic product availability. Consumers may face empty shelves or delayed deliveries, impacting sectors from electronics to groceries. This congestion also increases operational costs for retailers, which can be passed on to consumers through higher prices. The ripple effects extended beyond the ports. Trucking firms like J.B. Hunt and Union Pacific reported record demand amid supply chain stress. Retailers Walmart and Target warned of product shortages and rising prices. The $906 billion U.S. trucking industry expects a crucial recovery period during the back-to-school shopping season, hinging on steady import flows. Supply chain pressures increase prices and reduce product variety, directly affecting household spending decisions. Transportation, bottlenecks, and shortages risk disrupting retail promotions and seasonal sales, adding financial strain to American families. Ongoing tariff. Uncertainty hampers long-term business planning, especially for small and medium enterprises struggling to adapt to fluctuating trade policies. Consumers face risks of price instability and inconsistent product availability. Experts urge the government to implement clearer, more stable trade rules to support economic resilience and protect the American public from volatility. Without stable policies, businesses hesitate to invest or expand, potentially slowing job growth and economic recovery. Consumers bear the brunt of unpredictability, experiencing price swings and supply gaps that affect daily life and economic confidence.
American farmers are enduring a brutal economic fallout from trade wars with exports, collapsing production costs, soaring, and no solutions in sight. Can the U.S. agriculture sector survive this disaster? Sorghum exports to China have dropped 95%. In just 2 months of 2025, U.S. sorghum exports plummeted from 1.4 million tons to just 78,000 tons compared to the previous year. China once bought 90% of U.S. sorghum, but the market has vanished almost overnight. Other major crops like soybeans, corn, and wheat are also suffering, with prices falling and stockpiles growing. This sharp decline in demand is leaving U.S. farmers with millions of tons of unsold crops in silos, significantly hurting cash flow. The lack of buyers is pushing family-owned farms to the brink of extinction, especially as prices continue to plummet with no market alternatives in sight. China has raised tariffs to over 125% on a broad range of U.S. agricultural products, including soybeans, pork, corn, cotton, and dairy. In addition, the EU has also imposed 25% tariffs on key U.S. farm exports, like soybeans and processed pork, in retaliation for U.S. steel tariffs. Countries like Brazil, Argentina, and Russia are now filling the gaps left by the U.S., signing long-term trade deals that are shifting global supply chains. Permanently, farmers are seeing their once dominant positions in global markets erode with tariffs, pricing U.S. goods out of major markets like China. The agricultural sector faces long-term structural losses that will be hard to recover from. American farmers are now competing with cheaper products from other nations, leaving them vulnerable to further losses. A New York dairy farmer is facing an additional $2,200 in costs for livestock feed due to new tariffs on Canadian imports. Prices for fertilizers, seeds, and machinery are all on the rise because of tariffs on U.S. trading partners, putting immense pressure on farmers' budgets. Meanwhile, crop prices are falling, creating a double squeeze on U.S. farmers' profits. The escalating costs of production are making it increasingly difficult for farmers to turn a profit. With the prices of essential farm inputs like feed and fertilizer rising, and crop prices declining, many farmers are struggling to cover their basic operating expenses. The economic pressure is mounting, threatening their ability to stay afloat. Rural banks are warning of rising default risks as farmers face growing pressure from unstable crop prices and mounting debt. Many farmers are hesitant to sign contracts due to market volatility, fearing they will grow crops no one will buy. Despite some calls for new bailout packages worth billions, many farmers are voicing a preference for trade deals over government checks. As the financial crisis deepens, farmers are facing a real threat of bankruptcy. The increasing instability in the agricultural sector is putting banks and small rural economies at risk. The proposed government relief packages are seen as short-term solutions, with no clear path to restore long-term market access and stability. The United States and China have entered what may be the most intense phase of confrontation to date. With record-high tariffs, the formation of new alliances, and growing pressure on nations to take sides, prices, employment, and the security of millions are being directly impacted. Is there a constructive resolution on the horizon for this geopolitical struggle? The United States has raised tariffs on electric vehicles from 25% to 100%, and on steel and aluminum to 50%, along with a 70% tariff on numerous other goods. For some products, the average tariff has surged from 54% to as high as 145%. This move is expected to drive up prices for electric vehicles, energy equipment, and electronics in the U.S., directly impacting consumer spending. American businesses that rely on Chinese components may face rising costs, leading to further pricing pressure. At the same time, the U.S. has issued warnings to other nations not to assist China in circumventing tariffs by altering the country of origin. This creates added pressure on exporting countries such as Vietnam. Without transparent traceability, the risk of shipments being held or penalized is significant. The U.S. and India have set a target to raise bilateral trade to $500 billion by 2030, up from approximately $192 billion as of March 2025, according to the U.S. Trade Representative, USTR. On April 15, 2025, the two nations signed a preliminary trade agreement as part of the deal. India committed to increasing its imports of liquefied natural gas, LNG, from the U.S. to 10 million tons per year by 2027, nearly double the current volume, in order to reduce dependence on Chinese and Russian LNG. American citizens in LNG exporting states like Texas and Louisiana may benefit through job creation and rising incomes. In India, residential electricity prices in industrial states are projected to drop from 7.6 to 7.2 rupees per kilowatt hour by 2026. Beginning February 2025, India has imposed a 12% tariff on Chinese steel, an import market worth over $2.4 billion annually, to combat dumping practices. According to Reuters, this measure is expected to protect more than 320,000 jobs in the steel industry. As a result, Indian citizens may benefit from more stable prices in electricity and steel. China has increased subsidies for its steel industry, pushing low-cost steel exports to 94 million tons in 2024. According to Bloomberg, this surge has placed significant pressure on the steel sectors of the US, the EU, and India. Numerous factories have been forced to scale back production, directly affecting more than 320,000 workers. As of January 2025, China has suspended the export of rare earth materials worth $780 million to South Korea. This has impacted more than 37 defense companies, currently collaborating with Lockheed Martin and Raytheon. According to Yonhap, several production lines for radar and air defense systems have been temporarily halted due to raw material shortages in Canada. Public concern has grown over data security and electoral transparency, following allegations that China interfered in the national election by spreading disinformation aimed at discrediting 5 candidates known for their tough stance on Beijing, according to CBC. The scale of this interference has been likened to that of Russia's involvement in the U.S. elections in 2016. The primary objective of Trump is to prevent China from using third-party countries to bypass U.S. tariffs. In this context, China has sought to engage Southeast Asian nations, but has encountered resistance. Vietnam, Malaysia, and Thailand have publicly stated they will not serve as transit hubs for Chinese goods. Notably, Vietnam signed a contract to purchase 26 F-16 Block 70-72 fighter jets worth $2.56 billion, marking a significant step forward in defense cooperation with the U.S., according to Defense News. In response, China canceled its order of 48 Boeing 737 MAX aircraft valued at $6.5 billion. However, just 2 weeks later, Indonesia and the Philippines placed orders to purchase the entire batch, as reported by Nikkei Asia. The ongoing U.S.-China trade war is escalating, with bold moves from both sides. China is preparing strong measures, ranging from tariffs to financial strategies, in an effort to reverse the tide of the conflict. But will these actions be enough? The trade war between the U.S. and China intensified further, as U.S. President Donald Trump announced an increase in tariffs on Chinese imports to 145%. This new tariff includes 125% retaliatory tariffs and an additional 20% surcharge that was applied earlier. In response, China announced a 125% tariff on U.S. goods. However, the Chinese government stated that it would not back down or continue participating in the tariff escalation. China explained that the current tariff levels have already surpassed what is acceptable and have negatively impacted bilateral trade. It emphasized that further tariff increases would not improve the situation, but would only make trade relations between the two nations more unrealistic. China is now looking to shift towards diplomatic measures and dialogue, but insists that the terms of the trade agreement need to change in order to reach a long-lasting and fair resolution. Chinese President Xi Jinping spoke out about the trade war with the U.S., asserting that China would not succumb to suppression and would not make concessions in this confrontation. His statement came shortly after the U.S. imposed tariffs on Chinese goods and threatened to escalate its retaliatory measures. President Xi emphasized that China has developed independently for over 70 years and does not need help or preferential treatment from any other nation. He firmly stated that China would not yield to external pressure, reinforcing that the country will maintain its stance and continue to develop in its own way, unaffected by outside measures. U.S. President Donald Trump has also expressed his willingness to work with China to find a solution to the trade dispute. However, with China's firm stance, achieving a resolution may prove to be even more challenging. Simultaneously, China issued a travel advisory for its citizens traveling to the U.S. The advisory urges Chinese nationals to carefully assess the risks before planning trips to the U.S. and encourages cautious travel. This not only affects tourists, but also impacts Chinese students studying in the U.S. The warning could lead to a reduction in the number of Chinese visitors to the U.S., which would significantly affect the tourism industry and trade activities between the two countries. China currently holds approximately $760 billion in U.S. Treasury bonds, making it one of the largest creditors of the United States. This provides China with a powerful tool to pressure the U.S. economy should it choose to sell off these bonds. While this is a double-edged sword, as selling U.S. debt would also have negative consequences for China, it could still be used as strategic leverage in the trade war. However, China is fully aware that such a move could pose significant risks to its own economy, and thus, it will carefully consider this action before proceeding. The outcome of this escalating trade conflict remains uncertain, but China's firm responses and strategic preparations indicate a determination to stand its ground in the face of increasing pressure from the United States. Financial markets are rattled as the U.S.-China trade conflict enters an unprecedented phase. Interest rates are climbing, and the US dollar is losing ground. What lies ahead for the American economy? As of April 11th, US financial markets have experienced notable declines. The S&P 500 has dropped 8.8% since the start of the year, while the Nasdaq Composite has fallen 13.4%. The Dow Jones Industrial Average is also down 5.5%. Alongside equities, the yield on 10-year U.S. Treasury bonds has climbed to 4.5%, reflecting concerns over inflation and potential future interest rate hikes. The U.S. dollar has weakened, particularly against the euro and the Japanese yen. In contrast, gold prices have increased as investors shift to safer assets in response to currency depreciation and ongoing market instability. Over the past week, President Donald Trump announced a significant increase in tariffs on Chinese goods, bringing the total rate to 145%. This includes a 10% base tariff, a 125% reciprocal tariff, and an additional 20% aimed at addressing fentanyl-related issues. These measures are intended to encourage domestic manufacturing and reduce reliance on foreign supply chains, especially in critical sectors such as semiconductors and pharmaceuticals. China responded by raising tariffs on U.S. imports to 125% and stated it would not escalate further, regardless of future American actions. Additionally, China has imposed restrictions on the export of key resources like rare earth minerals, impacting U.S. defense and high-tech industries. These developments have contributed to global market fluctuations, with record gold prices, rising bond yields, and a continued weakening of the dollar. Across Europe, several countries are actively exploring deeper economic ties with China. Recent talks and agreements between the European Union and Beijing underscore a growing shift in international trade dynamics. One prominent area of cooperation is the electric vehicle sector. The EU and China are discussing the implementation of a minimum pricing mechanism for Chinese EVs imported into Europe, which could replace the current high tariff structure. Previously, the EU imposed tariffs of up to 35.3% due to concerns about state subsidies, but the ongoing negotiations aim for a more balanced and sustainable solution. Beyond EVs, discussions are also advancing in renewable energy and clean technology. During a recent visit to Beijing, Spanish Prime Minister Pedro Sánchez highlighted the importance of strengthening bilateral trade and investment in these emerging sectors. President Trump came under scrutiny last week following a social media post made on April 9th via Truth Social, in which he stated, "Now is a great time to buy," alongside the stock symbol DJT, referring to Trump Media and Technology Group. Just hours later, the administration announced a partial delay in retaliatory tariffs, maintaining a 10% base tariff on most trading partners. The timing of the post prompted concern from several Democratic senators, including Chuck Schumer and Elizabeth Warren, who have called on the SEC to examine whether the post may have provided an unfair advantage to those close to the president. On April 9th, DJT shares surged by 21.67%. Additionally, a video shared by White House communications aide Margot Martin appeared to show President Trump suggesting that some of his associates had benefited significantly from the market activity, raising further questions about potential misuse of privileged information. According to data from Freddie Mac, the average 30-year mortgage rate in the U.S. has fallen to 6.62%, marking the third consecutive week of decline. Despite this, broader economic sentiment remains fragile. The University of Michigan's Consumer Sentiment Index dropped to 50.8 in April, down from 57.0 in March, reaching its lowest point since 1981. At the same time, short-term inflation expectations rose to 6.7%, reflecting growing concerns over rising living costs and economic uncertainty. Major financial institutions, including Goldman Sachs, have revised their outlook, raising the probability of a U.S. recession in 2025 to 35%. These projections are driven by the combined impact of trade policy uncertainty and continued market volatility.